core inflation slowed modestly in the second half of last year, but recent readings have been somewhat elevated and the level of core inflation remains uncomfortably high. If energy prices remain near current levels, greater stability in the costs of producing non-energy goods and services will reduce pressure on core inflation over time. Of course, the prices of oil and other commodities are very difficult to predict, and they remain a source of considerable uncertainty in the inflation outlook.
The markets were rattled today when Fed Chairman Ben Bernanke reiterated his concerns about inflation, and investors soon realized that a rate cut was not in the immediate future. How big is this inflation problem, and just how strong is our economy? Joining me now, Brian Westbury. He's the chief economist at First Trust Advisors, and James Smith, Parsec Financial Management chief economist and professor of finance at Western Carolina University. Excuse me there, Jim. Mr. Bernanke says inflation is his chief concern, but you seem to disagree with that. Why has Mr. Bernanke got it wrong?
Well, inflation's coming down. You look at the truly horrible data like durable goods today, consumer confidence, slowing retail sales. The economy is slowing. That always leads to big declines in prices. Oil prices will drop again as soon as the Iranians release the Brits or the Brits bomb Iran or whatever happens. So there's no inflation threat out there. Nobody talking about their great pricing power. And Dr. Bernanke, well, the first thing he should do is slap his old colleague Alan Blinder up the side of the head and tell him to quit scaring people about free trade. Yeah. But the second thing he should do is be laying the groundwork for a dramatic decline in interest rates so that the economy doesn't go into a deep recession and only a mild one.
Now, Jim, you say you think the economy is heading towards a recession, and as I recall, you've got a recession countdown going on here. You think you know when it's going to happen. Well, please share it with us.
Well, I think it's going to start May 16th at 9:15 in the morning. That's what the yield curve would suggest. And if it doesn't start on May 16th, then keep watching till March 16th of 2008, because that's our range of history. The whole 20th century, every time we had an inverted yield curve, without exception, we had a recession within 9 to 19 months. I don't believe this time is different. Dr. Bernanke does. Perhaps he'll be right, but I doubt it.
Brian, jump in here.
Sure, I will. You know, Jim, I guess I'm in the argument position here, and nobody is bragging about their pricing power, I'm certain. But if you ever try to go to New York City and stay in a hotel these days, you know that at least hotel chains, and not just in New York City, have great pricing power everywhere you go. Inflation is rising. If you look at the core rate of the CPI, it fell late last year, but now it's started to rise again. We're up over 2.5%. The core PCE deflator, which is what the Fed really watches, has been above 2% for going on almost 2 years now. That's well above the Fed's comfort zone of 1 to 2%. That's why they're worried. Oil prices are back up. I do agree with you that if problems in Iran are solved one way or another very quickly, oil prices will come down. But that's not going to stop core inflation from rising. It's continuing to move higher. And then one last point, and that is that the inversion in the yield curve, this is kind of an interesting point. The 2-year and the 10-year Treasury yields inverted basically last October, but in the last few days they've now gone back to a positive slope. And I think partly that is because the market is getting less certain about the direction of short-term interest rates, and I think that's one of the things Ben Bernanke wants. And I think what that's going to do is add some risk to long-term treasuries that wasn't there before, and that's going to probably cause long-term interest rates to go up. So you're going to see a steepening in the yield curve take place in the next few weeks and months.
Brian, is the Fed right in being concerned about inflation principally? Did they get that right, or do you disagree with that point?
Oh, no, I think the Fed should be worried about inflation. Don't forget that the Fed dropped interest rates to 1% back in 2003. I think they held interest rates too low for too long. When they finally started raising rates, they raised them too slowly, and then they stopped short. They stopped below neutral. Interest rates aren't high today, and that's why I disagree with this fact that this would be a Fed-led recession that we're anywhere near. Right. Interest rates aren't high. They're still low, and they're still boosting economic activity.
All right, folks, May 16th at 9:15.
And inflation is falling, Bob. Inflation is falling.
Thanks very much, folks.